I'd like to welcome you to this presentation and thank you for joining us this evening for starting our investment journey. Our speaker this evening is James MacTavish, who is a senior advisor, investor, and industry education with Alberta Securities Commission. Welcome, James. You've done some programs with us before, but I think this one is going to be a really good program for anybody who is just starting their investment journey.
Hi, everyone. Well, thank you for joining me this evening for starting your investment journey. As Trish mentioned, my name is James MacTavish, and I'm a senior advisor of investor and industry education here at the Alberta Securities Commission. I'm delighted to be here and have the opportunity to present to you today about starting your investment journey. As you may all know, the news, our social media feeds, and day-to-day lives is filled with chatter on investing wins and what stock to jump in on next. And rarely do we hear the stories of poor investments. That's why I'm happy to have so many people attending today's class by taking the appropriate first steps in learning about investing. By doing that, you set the foundation for the right mindset and approach to meet your unique needs in life with investing. I highly recommend those that are interested to also check out my other presentations that I'll be doing with the Red Deer Public Library, including Recognizing and Avoiding Investment Fraud, as well as DIY Investing Fundamentals, a brand new program really dedicated to exploring what DIY investing is, if it's right for you, and really how do you approach it correctly and start to build out that portfolio for yourself. And before we get started, oh, my screen seems to be locked up. And before we get started, I just want to quickly remind folks that today's presentation is to provide helpful advice about securities and is not intended to provide legal, accounting, or other professional advice. So who are we? Well, the Alberta Securities Commission is industry-funded agency and really responsible for administering the province's securities laws. So making sure that there is a fair and efficient capital market for Albertans to invest in, and that companies and firms and individuals who sell or trade securities on behalf of others are doing so appropriately and in accordance to securities laws. And because we're not trying to sell anything, we can provide independent, unbiased resources to Albertans. So what we'll talk about today? Well, we'll talk about basic investment information, ways to manage and invest your money, how to invest safely, common investing mistakes, the fraudsters playbook, common scams and red flags, and how to report investment scams. So first things first, what is a security? Well, it is essentially a financial instrument that holds some type of value. Now, for example, when I buy a share in TD Bank, for instance, I expect to benefit from the efforts of TD in the form of dividends, or maybe my stock will go up in value. This is a type of security. Other examples include bonds, mutual funds, ETFs, loans, promissory notes. Really, the important thing to remember here is that no matter what the name is, giving your money with the expectation of return is a security. And by that, follows securities laws. So why do people invest? Well, there is a very natural response to this question of, well, to make money. But investing is so much more than that. If you look beyond the idea of just making money, investing is really something that helps you grow your wealth for the future, helps you have a healthy financial future, and afford the things like personal freedom in your retirement, or maybe saving for your child for their school when they're older. Really, investing is a tool to help you meet your life goals. And by taking that approach to thinking about investing, the better off you are in terms of staying away from fraudulent investments, get-rich-quick schemes, and really having an investing style that is really haphazard and all over the place. By having that clear and dedicated approach to investing and understanding what it can do for you in the long term, you can think appropriately about how to invest and invest in suitable investments for yourself. The more you can do that, the better you're off for it. Now, the interesting about investing is that there is unique accounts that are available to Canadians to utilize, and they all have different special features with them to help you achieve your goals. Now, there is unregistered accounts, and unregistered accounts are accounts with no limitations and really allow you to invest in it as much as you'd like. Now, investment losses are eligible for tax loss deductibles. So really you can claim your losses from investments with your taxes, but obviously you never want to try and do that. You're always trying to invest for success. And additionally, with unregistered accounts, capital gains, so when you sell investments, the profit you make off of that is taxed at your marginal tax rate of that year they are withdrawn. All of these accounts offer unique benefits, but what about the TFSA, RRSP, and RESP? Well, TFSAs are tax-free savings accounts, and they allow the capital gains on your investments to be tax-free. While this is great, it's also worth noting that any investment losses are not eligible for tax loss deductions, and this is because it's a tax-free savings account. The current maximum you can contribute to your TFSA, if you're 18 when it first launched in 2009, is $75,500, with an additional $6K of additional contribution room added each year with consideration of inflation. If you go over that $75,500 contribution room, you're charged a penalty of 1% per month. So you don't want to over contribute, but it's a great account to use because it's tax-free. The next, RRSP, was created by the Canadian government to help you save for your retirement, registered retirement savings plan. And it's not just for holding cash. I know that the term savings plan might sound confusing, but it's a common misconception. You can also invest in it with taxes on those investments deferred until withdrawal, ideally in retirement. Now, contribution room is 18% of your earned income from the year prior, and any carry forward contribution room from prior years. Now, the idea behind this is with taxes being deferred, when you invest in your RSP, you're investing at a time when your marginal tax rate is higher, you're working. When you're in retirement, you have a lower tax rate, and so you'll be taxed lower on the withdrawals, and it's had all those years to grow. So that's really powerful. The next is RESP, and that's a registered education savings plan. And it's a great way to invest in your child's post-secondary education. Every year that you add $2,500 to your child's RESP, the federal government will provide you with a grant as large as $500 to a total of $7,200 over the lifetime of the RSP. So really, that's a 20% return on every single dollar that you put into your child's RESP account before you've even invested it. It's a fantastic way to save for your kids' post-secondary education. And with post-secondary education costs constantly going up and only going to continue to go up, it's only going to become more important to save for that really expensive next jump in their academic career. So as you can see from these accounts, they help you achieve these goals in life that investing can help you reach. No one can afford, retirement right off the bat with one day of savings. This is something you work up to. This is something you work towards over your lifetime, and investing can help really magnify that growth. And we're going to talk about that in the next slide. Compounding interest. Now, this is what helps you really grow your wealth when it comes to investing. So much so that Albert Einstein called it the eighth wonder of the world. So what is it? Well, compound interest is the additional value generated on your original investment deposit plus the interest that it has already made in a previous period. It may not seem like much, but the effects are staggering over time. So let's take a look. So here we have Tracy and Donna. Tracy starts investing right out of school at the age of 20, or during school at the age of 20, and she invests $167 per month at a rate of return of 6% compounded annually, and she stops investing at the age of 65. Now, just $167 every month from the age of 20 to 65, the value of her investment is $426,338. That's massive. But the interesting part here is that the total interest earned is $336,000. So of that money, most like 3/4 of it came just from the interest, that compounding effect. That's Awesome. Now, let's talk about Donna, her friend. So Donna, bought a car. Maybe she wanted to focus on paying off her school debt first. And so she starts investing a little bit later. She starts investing at 35. But she also invests $167 a month. And she does it diligently from 35 to 65. And she invests in the same funds as Tracy with a 6% annual rate of return. Look at the difference of the value of her investment at the age of 65. $158,432, of which only $98,000 is of interest. So really, what happened here? They have the same figures in terms of how much they invested, the same funds they've invested in. What's that element? Well, time. Time is the element. Tracy invested only 15 years earlier than her friend Donna. Now, if Donna wanted to meet the same retirement amount as Tracy, she would have to invest $450 at the age of 35. And if you look at how much she has in terms of the value of her investments at age 65, she would have $426,914. But only $264,000 was of that interest. So even if she invests more money, that compounding interest still isn't as much as if you started earlier. That's a powerful thing. But I want to remind people that investing is really accessible by everyone over the age of 18. It's not something for the rich. It's not something for what you think is a very intelligent person. Investing is a great way to grow your wealth for everyone. And if you have the fundamentals, the right approach to it, the right behavior towards it, and the diligence to continue to move forward with contributing to your investments over time, you can come out of it with growing your wealth. And so I want to remind everyone that time in the market beats timing the market. It's not about how much you invest. It's really about how long you can stay in and invest diligently. And a great example is this. If you started investing at the age of 20 and you invested $25 a month at 6% rate of return, and you stopped investing at the age of 50, value of investment after 30 years is $23,717. And of that, almost 15 grand is compound interest from $25 a month. That's pretty incredible. So if you're on the fence of whether investing is right for you or if investing is something you can afford to do, even if you do $10 a month, once you start it and you get that flywheel going and compound interest comes into effect, you can grow your wealth. And it's really important to do that if you're looking to focus on long-term goals and really work towards them with investing as your main way of doing that. So really powerful stuff, and compounding is the way to do it. So we talked about compounding interest and the power of investing. So what are the types of investments available to you? Well, the thing with investing is there is a variety of different types of investments, and depending on your preference, your risk tolerance, your financial plan and goals, you can use any number of them, and you can use them in combination. You can use just strictly one, but really part of your investing journey is building out that unique investment plan for yourself. No one plan fits everyone. So we're going to go through the different types of investments available to you based off of their risk level all the way up to high risk. So the first is cash equivalencies, and these are generally secure investments with low risk, but they allow you quick access to your money, so it's very liquid. But as such, with low risk, they have low rates of return. Now, great examples of these are GICs or money market funds. But when you're looking at these types of returns, they're going to be a little bit lower than the yearly inflation amount, which is roughly 3%. And really, you're not going to see much growth of that of your money within those. But they're, again, very low risk, so very low chance of you losing your money, and very low returns. So if you're looking at short-term goals, you might want to use something like a GIC as opposed to something high risk, because if you need that money soon, you might not want to risk it with something that could potentially just take away all your money. The next is fixed income securities, and this is really almost like borrowing and lending of money. Really, the bond you buy is in which the borrower then pays you a fixed interest rate till the bond is paid back in full. Now, you don't have to worry about any of that when you buy a bond, but it's all set up in the back end, and you are paid it when the bond is cleared. So they're often less liquid than cash equivalencies, and great examples are corporate bonds and debentures. And the risk of fixed income securities is a little bit higher and provides a little bit higher return. These are also a little bit less liquid than cash equivalencies. So when you're thinking about using bonds or debentures, you're really thinking of a longer portion of time. It's not something that you can just jump into and jump out of quite as easily. So think about bonds in a longer term mindset. The next is equities. And this is what people think of investing right off the bat. You're thinking of stocks, you're thinking of shares, and they represent a part ownership of business, which is pretty cool if you think about it. You know, you're investing into the ownership of a business, and you're really investing in its success. So returns from equities are generated in two ways. First is profit from the business, which is called dividends. Now, what happens there is that you're paid a percentage of the stock's value on a set time frame, either monthly, quarterly, yearly, and depending on how many shares you have and that percentage, you'll get that money given back to you, which is great. You can either take that money out, you can reinvest it back into the company, you can invest it in something else. But that's one way called dividends that you can get money from your equities. The other is capital gains, and this is quite simply the value of the stock goes up. So if the stock is $4 and goes up to $6, that's a capital gain of $2. If it goes down to $2, that's a capital loss of $2. Common examples of this is common shares and preferred shares. Now, the risk here is variable. Now, the reason I say that is because there is a variety of different companies out there, companies that specialize in just cereal for the past 200 years, and that's that. They might not have the volatility and risk of, say, maybe a tech company or a company that just started making EV vehicles right off the bat. So there's a different level of risk for all these different companies, and by doing your research, you can understand what kind of risk you're inherently facing by investing with them. But ultimately, it's all variable, and it depends on your research to invest in stocks. The next is investment funds. Now, instead of owning just a single egg, you can hold a whole basket of eggs, and that is an investment fund. It's really, you're holding a broad selection of stocks, different kinds of securities, different kinds of asset types. You can hold different types of stocks from different global markets. Really, you're investing in really essentially a basket of a well-diversified group of investments. Now, these can be actively or passively managed. And what I mean by that is that actively means that there is some type of wealth manager or financial advisor that is controlling what is inside of that investment fund. And really, you're paying for that active engagement with the fund to rebalance it, make sure that it's got the right amount of this or that global percentage. And so you pay for that service. Now, the cheaper option is passively managed. Now, passively managed means it runs off of matching indexes. So matching lists that could be like the S&P 500, the Standard & Poor's top 500 companies in the US. And it just matches that and follows those companies. Because it follows these lists, there's no need for a wealth manager or financial advisor to actively manage it. So it's a lower cost. Now, this is a great way to diversify your portfolio because you're investing not just in one company to do really well, but thousands. You could invest in different types of investment funds that cover things like the cannabis industry, or cover the entire global market, or just all of Canada. There's ones that have it pre-made for certain levels of risk. So certain amount to equities and certain amount to bonds, all ready to go, all in one investment fund. So it's a great way to diversify. But one thing I want to mention is that the risk here is variable as well. There is thousands of different types of investment funds, And they all try to go after different objectives with different risk tolerances in mind. So that's something to be aware of. Great examples of these are exchange traded funds and mutual funds. And here you can always look at mutual funds fact sheets or exchange traded funds fact sheets, and you can understand their objectives, their risk level, the cost, which is very important, the amount of fees that you'll be paying, and really get an understanding of what this investment fund hopes to achieve and how you can add it to your portfolio to achieve your goals. The last is alternative investments. Now, these are unconventional and complex investments, and they usually offer high potential for return, but they also have a high degree of risk and complexity that could hurt you. So it's something to be mindful of. And if you're new to investing, it's something that you should not just jump into right away before you understand more thoroughly what you're getting involved in. Great examples of these is cryptocurrencies, so digital assets, private equity, options, derivative contracts, and hedge funds. So risk here is high, so make sure if you're exploring these that you go in with the right knowledge of what you're getting involved in, and if it's right for you, make sure you check if it's suitable. All right, so let's go over key investment terms. So one of the key investment terms was compound interest, and we talked about that earlier, so I won't go over that, but that's an important thing to remember. Time in the market beats timing the market. So the longer you can hold your investments and let that compounding work for you, the better. So always remember that's a key investment term that you should remember. The next is diversification. Now, with diversification, it is the investment strategy of utilizing a variety of different asset types to spread out your risk and drive steadier returns. Now, this is great to have. Instead of relying on maybe one sector like technology or relying on an individual company, with diversification, you can really spread out that risk and have a smoother ride. And really, that's kind of what we all want. We don't want these massive dips in the market. While they may still happen, we want to do our best to spread our risk and make sure we come out on top and in the green. So diversification is an important thing to do within your portfolio. Now, I mentioned portfolio a few times already. Well, what is a portfolio? Great question. Well, it is a collection of your investments. So think of it of almost like a garden, and your investments are seeds, and you're planting the seeds all over your garden to meet your needs. So fundamentals of investing with long-term success means looking at and reviewing your entire portfolio of investments and adjusting as needed. So as you're tending to your garden, you're moving things out, putting things in, and really taking care of it. And that's really about your portfolio is the same way. You have to monitor your investments and take care of them and continue to contribute to them and water them, much as you would a garden. The next is risk versus reward. And this is really about the principal trade-off between risk and reward of investing. So remember, there's always going to be the dynamic of the higher the risk, the higher the reward. The lower the risk, the lower the reward. Investors must assess the risk tolerance and always examine the risk reward of any investment opportunity they are considering. This is very important because a lot of people get involved in investments that are way too risky for them, and they're too focused on the reward component, and they forget about the risk till they're in it and they see a drop and they're sweating at night and they're constantly checking their investments. You want to invest in suitable investments for yourself that meet your time horizon, so meet your goals and don't keep you up at night. The next is capital gain, capital loss. I talked about that. That's really about the increase in the capital assets value. And when you go to sell it, that's capital gain. And if it's above what you bought it at, that's capital gain. If it's below, it's a capital loss. The next is return and or yield. Return is the profit you make on an investment through interest, so dividends or increased value of the investment, whereas yield is expressed as the annual rate of return on your investments. Interest rate, this one is powerful. So it is the rate expressed as a percentage you earn on the money you lend or hold in a fund. It can also be a rate of a lender charges to borrow money. So a great example of this is a credit card. Credit cards on average have an interest rate of about 18.99. So the money you borrow, you're charged 18.99% annually on that existing balance. And so remember, just as compounding interest works for investing, it also works for debt, and it can magnify your debt and what's owed on your debt. So as investors, remember the power of compounding, and it's always great to pay off debt and get those credit cards down, because those interest rates can really, really kill your returns from your investments, because they're coming at you from the debt perspective as well. So always try to focus on paying off debt if you can. The next is liquidity. And I mentioned this one a couple times, but really it's the ability to sell investment quickly and at a fair price. So some investments you can't get out right away. And that's something that you have to take into account if you do need this money right away. If you're looking to buy a car soon, or if this is money you need for emergency, it's probably not something that you want to put into something that into an investment that's not very liquid, or an investment at all if you're using it for emergency. Next is volatility, and volatility is the fluctuating, how dramatic the fluctuations of price are for the asset or the security. And really this is over a set amount of time, but if something rises, at the start of the day and plummets 60% of its value by the end of the day, that's something that's probably pretty volatile. And there's a variety of different securities that will have different levels of volatility, and you can look into their past performance to get an understanding of that volatility. But it's something that's very important in terms of understanding if it's the right risk level for you. And finally, management fee. There's a variety of different investment products out there that provide you with different services and products. And because of that, they also have a management fee involved. This can be a management fee based off of the assets within it, but also the advisors that are helping you kind of put that all together. So there is management fees. The important thing to remember here is to always look at them and understand how this will impact your investments, not just today, but in the future. As you grow your wealth and you have your investments, maybe in the $500,000 range or something like that, management fees can eat a lot of that value. So make sure you understand what that number is, how it can affect you with your current investing cycle, and how much you put into your investment account, and really calculate it for what that would look like later on in your life, and see if you're okay with that, or if there's other low cost equally as interesting investments that you can get into. So make sure you remember those management fees and acknowledge them and know how they can affect you. Okay, so with that, we've talked about the different types of securities. We talked about important investment terms, but ways to manage and invest your money. There's three main ways to invest your money. And I want to reiterate here that there is no wrong answer here for you. If one speaks to you as the way you want to invest, there is no wrong answer. These are all equally viable ways of investing, and they all serve their purpose for the different investor. This is, again, a unique journey for all of us, and the needs of each one of us is different. So these are the three main ways to do so. The first is through a financial advisor or investment professional, a registered investment professional. Now, this person provides in-person meetings and really provides you with that personalized experience. They really help you first sit down, understand and assess where you're at currently, what your goals are with investing, and really sets up that comprehensive plan with the financial, the bundled services and that financial plan all laid out for you. Now, this is perfect for someone who has limited time or interest, or really the knowledge or experience to approach this in a meaningful way. They want to have a specialist help them do that. And that's perfectly fine. This is what a financial advisor is for. And this is also for someone who wants in-person feedback. There is so much news out there. There is so much talk about investing that some people want to have that specialist in their corner to go, hey, I've heard about this investment fund or this stock. Is this something that I should be looking at in terms of my portfolio? And the specialist can comment on that. The other element this is great for is, as your life changes, a financial advisor can be there to help you manage these changes in your life. So maybe you lost your job, or maybe you've moved up in your company or your organization, and you're being paid more. And maybe you want to divert more of that money to your investments, and you want to see what that would look like for you. Financial advisors can help build that picture for you and help you stay on track, or change and adapt your financial plan as your life changes, which is pretty amazing. The next is do-it-yourself online or discount brokerages. And these are really for the do-it-yourself type of individual who really wants to manage every component of their investment portfolio. This is someone who wants convenience of lower fees, is comfortable with online technology and the terminology of these investment platforms, and can manage their investments without outside advice. They're really confident in their investment knowledge, and they can approach it with the understanding of what they want to get involved with, and really what is suitable for them. The one element of online brokerages is that you have to stay actively engaged. You do not have anyone else helping you, monitoring your investments. This is up to you. So this is something that you have to take on, carve out the time for, and dedicate yourself to when you can. This is something for someone who really wants to really create that tailored package for themselves. But again, it does have those drawbacks of being all up to you. The next is robo-advisors. Now, this one's pretty neat because it's a combination of that personalized approach and DIY approach. Robo-advisors is really about providing a templated portfolio of investments to an investor based off of questions they answer. So they offer you a questionnaire right when you sign up, and you go through it. And this the questionnaire helps to define your risk tolerance, your time horizon for when you're going to be using the money in the investment portfolio, and really helps understand what kind of suitable investments are right for you. Now, from that, an algorithmic process that has been created by wealth managers, financial advisors, and data scientists at these different robo-advisors creates a portfolio that's tailored to, or not tailored to you, but that meets your answers from that quiz. Now, the thing here is that while your answers to the quiz will provide you a portfolio, this is a portfolio that is used by thousands of other individuals who have answered that quiz the same as you, or if not close to the same way you have. This is not something like working with a financial advisor where they provide you a very tailored investment portfolio for you. Robo-advisors have a templated type based off of that algorithmic process. But because there's no involvement of a financial advisor, the fees are lower, and it's something that you can start up right away and get going with. Now, things to consider. When it comes to a financial advisor, they might have a product bias. Now, they might lean towards a product at their bank, but with new rules coming in at the end of the year around know your client and client-focused reforms, they'll also have to outline other products available that meet your risk tolerance, meet your needs, but also have, if they're cheaper funds, they'll outline those, but they help to really map that out for you. They also are only as good as really how much information you provide them. If you're not providing that in-depth information and being transparent about yourself, they can't provide you with a suitable investment plan that works for you. This has to be an open relationship in which you're very transparent in terms of how much you're making, what your goals are, where you see yourself in certain timeframes, for them to best pick investments for you. And you have to be open about your risk tolerance. Really drive home what that comfortable risk level is, and they'll provide you a know your client questionnaire to help discover that. But this is really about focusing on what's comfortable for you to get the best results. So if you're suggested an investment portfolio and you're just not comfortable with it, you can say you're not and outline that, because again, this is your investment journey and they're there to help you. So provide that information and be open and transparent. And you should expect to meet with your advisor at least once annually, because this is something about nurturing your investment plan. So By meeting them, you can see if you're on track. You can talk about the past year, the future year. This is really about maintaining and growing and making sure you're evolving your financial plan as it's needed. So you have to meet with them. Things to be aware of. The next with do-yourself online brokerages is it can be hard to focus on your goals with all the talk and buzz and excitement around investment news. As a DIY investor myself, I can full-heartedly tell you that it is so hard with all the noise and constant barrage of, oh, this is a stock you got to get into. Oh, you're going to miss out if you don't get on this. And you have to stay focused. This is about really nailing your plan, your investment plan, and staying focused on it. And you have to do your research and be aware of your own financial knowledge and limitations. If you certainly don't know anything about options, do not start investing in options right off the bat. Because in DIY investing, you can jump into options. You can make costly mistakes, and there's no one to answer for it but you. So make sure you define where your knowledge level is, and if you're ready for something like that, and really stick to your investing goals and don't be distracted by what's out there. The next is robo-advisors. And the thing to remember with robo-advisors is that investments may not always be personalized. This is really built off of algorithms, and really the recommendations are only as good as the information you provide. So make sure you answer those questions openly and honestly, and you'll get a portfolio that's best tailored to your suitability needs. All right, so we've talked about the ways to invest. So how to invest safely? Because I think we all want to do that at the end of the day. We don't want to be involved with fraud, and we may want to make sure that we're doing the right approach to investing. Well, we define the check, protect, and invest format. So first is check. So if you work with an individual or an advisor, you have to check the registration. By law, if you're selling investments in Alberta, you have to be registered here in Alberta. And that's the very, very few instances where that's not the case. But if someone tells you that, you can always contact the Alberta Securities Commission and we can take a look into it. The other great thing is that when you check registration, you can also see their disciplinary history. And that's something that you can easily do at checkverse.ca. You can check registration and then go right and see their disciplinary action, see if they've acted against securities laws. So you might not want to work with someone who's done that, even though they're registered. It gives you that insight into that individual or firm. The next is once you've figured out that they're registered and the disciplinary action list is okay with you in terms of if they haven't done anything. Next is you have to figure out if they're really right for you as a financial advisor. You can easily lose money with a financial advisor that makes investments that aren't suitable for you. And there's a variety of different kinds out there that focus on late stage investors, so getting ready for retirement, to young and more interested in risk involved investments, to everything in between. So make sure you understand what they're specialized in and if they have clients like you. Also ask the right questions. How are you paid? Very important question. There's a variety of ways they're paid, either fee-based, so you pay them flat fee for hours that they spend with you, or commission based off of your portfolio, or some kind of mix or blend of both. So make sure you understand how they're paid, and if you're okay with it, and think again long-term, how that might affect your investments over time. The other thing is, how will you help me reach my goals? Really let them outline how they plan to help you get to your investment goals. And if you're comfortable with it, then you can move forward. But if you're not, make sure you identify that, tell them why, and if they can't answer it to your satisfaction, maybe you need a different financial advisor to help you. And what level of service can I expect? This is important. If you're expecting to meet and talk to your financial advisor for 10 minutes every month or every 6 months, make sure you define that. If you don't define it, this is something that can go unspoken, and as you go into the relationship, you might find that you're only meeting them with the financial advisor once a year, and that might not be to your satisfaction. So define that upfront, how often you want to meet and communicate and how you can communicate with them. So check registration, again, super important, but by checking registration, you're making sure that you're working with a qualified, registered, and legally allowed to individual that's selling securities. And just under 1 in 5 Albertans do that right now. So very important. You can do that at checkverse.ca. Very simple, takes 2 minutes. And next is protect, do your homework. When considering any investment, do your research. Is it legitimate? Dig into its public reports, look at the company history, check out its website, digging into third-party resources to understand, really, is this something that is tangible and can grow and has prospects of growth? Then look into is the risk return profile right for me? Is the level of risk for this investment right for you? Is it too much? Are you thinking too much about the reward part of it? Maybe pull yourself back, think of that risk, and really ultimately, how much can you handle there? Now, if you don't know your risk profile, checkverse.ca also has a risk tolerance quiz that you can take. I highly recommend it. It can help you define what that number is. Next is, do I understand the industry, company, or investment? It's very, very important to understand how this company operates, but also where it operates, the industry, its competitors, what kind of opportunities, challenges it faces. The cannabis industry had some, in the US, had some laws and regulations per state. Now that could totally affect your investments in the cannabis industry. But you wouldn't know that unless you understood its industry and sector and really the investment itself. So make sure you understand those deeper elements of that investment. Does it fit with your investment goals? Always tie everything to your investment goals. It's critically important that you do that. If you don't, you're rudderless. You're just kind of investing aimlessly and you don't know where you're trying to aim and get to. And are there any hidden costs? If there's any type of fees, look into it. Make sure you understand and can qualify what those fees are before you get involved with any investment. And does it sound too good to be true? Unfortunately, that saying is still, on point today. It's too good to be true. It usually is. If you can't find the risk, if you can't find the elements that don't make it such a for sure thing, you might be dealing with a scam. So make sure you understand those things. And finally, no research, no financial plan makes you an easy target for fraud. So make sure you develop that plan before you start investing and do that research. And if you don't know how to build a financial plan, you can always work with a financial planner who can help you develop that with you by talking to you about your goals and life needs. And remember these important tips. Ask questions and demand satisfactory answers. Stick with your own investment goals. Do your research, company, investment, firm, and individual. Be skeptical, know and watch out for the red flags, which we're going to cover in this next couple slides. Talk to others about finances and don't be a victim of your manners. You don't have to say yes to any type of investment, and don't be fooled by appearances. Don't think that just because someone looks successful, that they are legitimate and are registered. You have to double check everything and do your research. Really, no one cares about your money more than you do. So by taking that time, you can then invest and invest confidently now that you've done the research. It sounds like a lot of work, and it is, but really this helps you establish the fundamentals to investing correctly and confidently, and doing all the elements of research that can make sure that the investment is legitimate and is suitable for you and meets your investment goals. So next, common investing mistakes. And these are things that we've all seen before. Long-time investors can even say, hey, I've kind of experienced some of these myself and I had to kind of stop. But investing before researching, don't let the buzz or online hype get you to invest in something before you do that critical research to see if it's right for you. Not identifying your financial goals. Make sure you understand what those goals are for yourself and how investments can get you there. Remember, it's a tool. It's not just about getting rich right away. It's not about just making money. Getting caught up in unsuitable investments. If you're investing in things that are way above your risk level and you're just ignoring it, you're going to have a hard time. Not knowing your risk tolerance or comfort. Again, use a Checkverse risk tolerance quiz. Great tool to have. Ignoring your risk. Don't ever do that. It's an important, critical element of everyone's investment journey. Having too few or too many investments. Remember, it's like that garden. If you only have 1 or 2 plants, that's not going to be really helpful if something happens to one of them, you're left kind of hooped. If you have too big of a garden and you can't manage it, you can't water it, you can't nurture it, it's going to become something that's going to get dominated by weeds and not grow correctly. You want to have just the right amount of investments that you can manage and monitor and nurture. So make sure you're looking at that and make sure that it's diversified. Ignoring investment fees, that can kill you over time. So make sure you watch how those are impacting you. And finally, not monitoring your investments and their performance. Make sure you're doing that at all times when you can. So now we're going to move quickly into fraud, but what percentage of Albertans believe they've been approached with an investment opportunity that may be questionable, not entirely real, or potentially fraudulent? Now, a lot of people think, fraud doesn't really happen. Does it happen? Well, the correct answer is 48% of Albertans. Fraud does happen, and the more we can understand the signs and recognize the red flags, the better we can do from staying away from them. This number is pretty shocking, and that increases to 54% for age 45 to 64, and 60% for Albertans age 65 and over. Pretty startling. That's why we created the Don't Be Fooled by Fraudsters playbook, and this is to help you because it's difficult to recognize fraud and when it could happen to you. It's a new resource that outlines the tactics a fraudster takes to implement a scam and gain your trust, but also the actions you can take to recognize, avoid, and report those scams. So it's really a powerful tool. And you can check it out at checkverse.ca/playbook, and it's a great read. I highly recommend. So just to go over the steps quickly, first it starts with the fraudster targeting a possible victim based off of maybe their fear of missing out on a stock, or maybe they're worried about their retirement savings. Maybe they've just lost their job and are looking for extra money, and they're thinking that investing is the way to do it. Once they've found that target, they quickly befriend and earn their trust, and really try to become that main person in their life. Once they've established that, they move into step 3, which is they showcase the benefit of an investment. So they might pull up in a nice car, they might kind of brag about their nice house or their clothes or their watches. Really, they're showcasing the benefit of their investment at that step. Once they kind of have the interest of the target, that's when they start to lean into offering the opportunity. They become highly communicative about this. They reassure them constantly about how this investment will help them. And this can be either online or in person. And they'll do this constantly till they get to stage 5, which is receive the money. At this point, once they've received the money, they pull back. So this person will then start to maybe ignore messages. You might not see them as much. They really become kind of a ghost from the target. They just disappear, which is step 6. When they finally disappear. This is usually when people recognize that they've been defrauded, but most people don't recognize that there's a step 7, which is target the victim again, the Recovery Act. And this is where the fraudster will sell your information to other fraudster rings who will contact you acting like the Red Deer Police or an investigative firm, or maybe even a different investment firm that's trying to recover your funds, and they'll do it for a fee. Now, you pay this fee and they disappear. So they've just double defrauded the victim twice. No legitimate organization, Red Deer Police, the Alberta Securities Commission, will ever charge you a fee for helping you when you're a victim of fraud. So make sure you always contact us if this has happened to you. And common ways of being approached. Really, during the pandemic, a lot of these elements of meeting in person was obviously put to the wayside, but they can meet you in a variety of different ways. And really, the element that we have to remember is that investment offers that are possibly fraudulent can come in through social media, through our friends and family, which I'll talk about later, over the phone, emails, and even through the internet and radio and stuff like that. So you have to be mindful that these are coming at you from all different angles. And the more you can do the research and do those preliminary steps and take a step back and think before you invest, the better off you'll be in terms of recognizing any kind of possible fraud. And we'll go over the red flags of fraud. These are the telltale signs that you might be dealing with a fraudster, and don't ignore these. If a red flag pops up in your head, that's really important to recognize and remember. The first is high rates of return with little or no risk to investors. Now, this is simply not true. That can never happen. With high rates of return always comes high risk. With low rates of return comes low risk. Anyone who tells you differently, that's a cause for concern. If that was true, we'd all be rich. If we could all invest in things that give high rates of return with no risk, we'd be rich. And you have to ask yourself, why would someone want to get you in on this investment if it's so profitable and so amazing? If they could get in on investments that are high rates of return with no risk, why would they bring it to you? Make sure you recognize that and stay away. Offshore investments are tax-free. Taxes can sometimes be deferred, or they can be tax-free in a tax-free savings account, but typically investments aren't tax-free. This type of deal is often pitched as a secret, so you won't have to answer questions from family, friends, financial advisors. You're persuaded to send your money overseas to invest in other markets that aren't, tied to our tax system. But really, these platforms and sending your money overseas, the money is gone, and there's no way to find it. There's no way to go after the individuals, and so oftentimes these websites are completely fake. So there's no way to have a tax-free investment in itself. You can defer taxes through RRSP and RESP, and with a tax-free savings account, you can do it with that. But other than that, there's no such thing as tax-free investments. Exclusive offers. This is something that investment or fraudsters will try to sell to you because they don't want you to talk to other people. So they'll say, this investment is just for you. You have to get in. I'm selling it just to you. Remember that investment advisors will never act like that. They will never just tell you that investment's just for you. So that's a cause for concern and a moment to back away. Talk to others about it. Do your research. Check if they're registered, and do some digging into the investment before you ever hand over your money. Insider tips. This is something that's often used in investment seminars. They say they know insider information about the company. Right off the bat, any kind of insider information that's provided to you, this is illegal. And you can report this if you do get insider information from someone. Information on the public market has to be public so everyone can utilize it. That's part of being a fair and efficient capital market. So insider tips right off the bat is something you need to stay away from right off the bat. Next, lack of registration. You do never want to work with someone who's not registered. By law in Alberta, you have to be registered to sell investments. So make sure you check registration, and if they're not registered, that's something there you need to just come to breaks and not work with them. Celebrity endorsements. There's a variety of celebrities out there talking about different types of investments to get in on. Don't let that be a guiding path for your investment plan. Ignore those. Pressures to invest immediately. Do not let anyone pressure you to invest before you do your research. That is critical and important. Part of investing is doing that research. Fraudsters, that's their weakness, is that research component. That can help you find the holes in their investment. Do that research and keep that as a red flag that someone's trying to pressure you into it. No registered financial advisor will ever do that to you. And investing in emerging markets. Well, this is interesting because really it's all about fraudsters capitalizing on new and trending types of things: cannabis, green technology, oil and gas exploration. They really look to appeal to investors and really the excitement around something. So make sure anything that's offered to you in terms of investment that's around a trend, that you take note of that and you do that research, because it might be just someone hiding it. Hiding a scam under this new trendy thing. Now, common types of fraud. Now, these are common types of scams we see. Affinity fraud, I'll cover in the next step, but I want to talk about these a couple here first. Ponzi schemes is a type of scam in which investors are promised high rates of return with little to no risk. In actuality, there's no real investment, and the scam is perpetrated only as long as new investors invest money into the scheme, which is funneled up to the scam artist. Once there's no new investors, obviously the whole Ponzi scheme collapses and the fraudster gets away with 99% of the money. It's awful. So remember that this is something where there's no real investment. If there's something confusing or complex, it's looking like a Ponzi scheme, especially if the whole basis of it is getting new investors coming in. The next is pump and dump schemes. And we saw this a lot during the pandemic, but it's a scam in which a fraudster will purchase large quantities of a cheap stock and begin falsely promoting the stock as an incredible deal. So talking about new products, falsely talking about new products, new innovations and technologies. As new investors buy in, the stock price rises, and once the shares hit its peak, the scam artist dumps the shares and the stock plummets, leaving everyone with the worthless shares. Something to be mindful of. When someone's promoting a type of investment, do your due diligence and research on your own. Make sure you really dig into it and see, not just the information he or she provides, but your own information that you can dig up to see if it's actually credible. And binary options are like bets on how an asset, like a currency or stock, will perform in a limited amount of time. I like to think of them as all or nothing wagers, similar to gambling. Investors are required to create a trading account, supply their credit card and other personal information, and make an initial deposit before starting to trade. They'll see virtual gains, but all of this money that's gone into the platform is inaccessible and is gone. This is the same for Forex trading. Now, foreign exchange trading isn't illegal, but there's a lot of companies out there who have been advertising it as a great way to make money from home for those who maybe lost their jobs during the pandemic. Now, foreign exchange trading is trading foreign currencies on a fluctuating basis to capitalize on their changing prices. Now, these fraudsters will say that it's a really easy way to invest, and they'll teach you how, and their platforms are completely fake. You put your money in and they're gone. Their training programs are completely fake. You pay for the training and it's gone, and they're just fake websites. So be mindful of that, and that foreign exchange trading is not easy and it's not for beginners. Recovery room scams, this is really, again, targeting victims again, and emerging sector scams, we talked about that, in which they target people based off of the different types of trends that are out there and capitalizing on that. Now, affinity fraud is the last thing I want to quickly talk about before we finish, but affinity fraud starts close to home, and this is one of the most pervasive and insidious types of investment fraud. And a scam artist takes advantage of the trust and friendships within groups and friends, and this can really happen in religious organizations, ethnic communities, social clubs, professional associations, any kind of group setting. This can happen, and really, it's about the scam artist taking that trust element of friendships and really enlisting unsuspecting leaders to sell his scam or their scam. What this ultimately looks like is that your friend of maybe 10 or 15 years comes up to you and tries to get you in on an investment that they've made a little bit of money on, and they all only want the best for you, but they don't know that they're already invested in a scam, and that the little money that was paid for them could possibly have just been from another defrauded victim. You invest as well, and now you're defrauded, and the scam artist had to do nothing, just take your money. So remember, the best way to avoid affinity fraud is to see where it originates from, the investment, and make sure you check the registration of the person that's offering it, where it originates from. Do that research before you hand over your money, and remember, don't let your friend or family member's lack of research be your lack of research. So, like I was saying about investing in emerging technologies or emerging trends, these are all the top emerging trends. Now, these are not technically against the law, but these are what scammers will tie their scams to and talk about. So make sure that when it comes to these, that you're mindful that these are also used for promoting scams. And finally, I just wanted to tell everyone that checkverse.ca is the investor education website of the Alberta Securities Commission, and it provides free and unbiased resources for you to utilize. So video learning series, quizzes and calculator, budget sheets, fact sheets, and the check registration tool, which is very, very important. So with that, I just want to thank everyone for joining today, and I'd like to move it into the question and answer period.
Hello, hang on. Let me just bring up my video again.
Yeah.
Somebody just came along and turned out all the lights because she didn't realize I was in here. Okay, so we do have a couple of questions here and
Great.
comments. Deborah just mentioned it was very interesting on point number 7 about the Recovery Act.
Mhm.
She didn't realize that that could be a further fraud. So that's something there. Now, somebody did ask whether or not it's possible to get the PowerPoint. I'm not sure if that's something that you do.
Definitely, yeah. Reach out to me and I can send them the PDF of that. So
Okay, certainly I can send you people's emails and we can get that. I did also tell them that this will be available again on YouTube and on Facebook Live. So, so Naomi was wondering whether or not all financial advisors charge. She said she has talked to financial advisors at the bank and they've never mentioned a charge.
yeah. So it's one of those things. Everyone has to, you work for money, right? So a financial advisor has to get paid for the services they're providing you. You are a client at the end of the day. Now, they might not have expressed it in that meeting with them or that brief occurrence with them before talking about having them as your financial advisor, but they certainly do get paid from you. Now, if they're not getting paid by fees per hour, they're getting paid by commission on your investments. So, they could maybe take 2% of your investment portfolio on an annual basis, but they certainly do get paid. So please don't think that there's an element of a financial advisor helping you without some type of fee being paid there for their services. Great question, though.
Okay. And let me just see if there's anything else that's come through.
Hmm.
And it doesn't look like it. So that's just great. James, can you tell us a little bit about the October 5th presentation that you're going to be doing? Sort of an extension a little bit of this in some ways, isn't it?
Yeah, and that's the DIY presentation, I believe.
Yes.
Yes. So DIY, right now, a lot of people are talking about do-it-yourself investing, and I mentioned it briefly here about that being a particular route you can go down with investing. Now, with DIY investing, there's a lot of considerations about your cognitive behavior, so ways that everyone's brains just think. It's survival instincts, how we approach investing, how we approach the losses and gains we might experience. So we covered those top elements of investing on your own. We cover if investing on your own is right for you. So how to approach examining investing in the different routes and which one's right for you. And then ultimately how you go about building that financial plan, things you should consider with your financial plan, and then ultimately how do you pick out those investments for yourself. So really important questions that I think a lot of people, kind of want to get into DIY investing, but don't really know the fundamentals. So we help out there. So very, very great presentation for people to get into if you like this one.
Absolutely. So that sounds good. So anybody, that again will be Tuesday, October the 5th. And again, it will start at 6:30 or whenever I get the video up and running. All right. Okay. Thank you, everybody. That's been great. And I will now shut off, say goodbye, good night to everyone, and we will see you next time, October the 5th.
Bye, Ron.